So thanks a lot for joining us again today for another webinar organized by Princeton for everyone worldwide. We're very happy to have John Campbell with us from Harvard and Tarun Ramadorai from Imperial College in London. And they will talk about personal finance and their new book, Fixed. Hi, John. Hi, Tarun.
Hello. Thank you for having us.
Thanks.
It's great to have you both. And let's talk about your book. So here's the cover. So it's Why is the Personal Finance Broken? And you will also provide a solution, how to make it work for everyone, not just for the wealthy. And it's an interesting, important book, how to design the financial system in such a way that it's beneficial for everybody. Let me give a few opening remarks and then we pass it on to everybody of you. So one philosophy could be free to choose any investments you can choose, but of course it has the advantage or has disadvantage that other people can take advantage of the less financial literate. And so we have to take care of this. So should we choose that? So one is to say we should actually limit the choice set. So people can only choose investment products, insurance products out of a limited set of possibilities. Or they can actually, they have to consult some experts or the regulators decide how to design the choice set. And that's a little bit similar what we have in the FDA in the medical field, where there's an analogy going on. So you requires, in order to make the right choice, if you have a huge big choice set, you have to have expertise, you have to have information, but there might be information and cognitive overload. So it's an argument we should have a simpler system. And, you have to be very rational. And most of us, suffer from behavioral biases. And that's also a big challenge. And of course, if the choice set is very large, we need a lot of advice, and this will cause some fees which we have to pay to the financial sector. So designing this financial system such that it works for everybody, also for the less wealthy, I think is a big challenge. The other challenge I think I would like to raise essentially is that what we have often is some staggered participation. So initially when some new product comes along, very few people can participate, and then they push up the price of these products cause high capital gains. And once you're in bubble territory, you push it on to the retail investors. So there's this saying, from Joseph Kennedy, the father of JFK, when the Shoeshine boy starts giving stock market tips, it's time to get out of the market, showing that, initially it is the case that, you buy stocks, you push it up, and then it gets very high. And then when the participation is very broad, then actually it's time to get out because the people getting in at the end are the less financially literate people. And that raises the question concretely, should retail investors be allowed to put their 401k investments or retirement savings into crypto at the moment, or private credit or private equity, which seems to be at a very high price at the moment. People who got in very early on, they will benefit from pushing it up and then get out of it at a very high price. And how should we handle with that, or how should there be a restriction to what extent you can put your retirement savings into these more highly speculative, illiquid assets? Now, the other application, of course, how when you design the financial system, you can design it different ways. And particularly if you look at the retirement system, you can have a pay-as-you-go system, or you can have a fully funded system. The pay-as-you-go system is much more simple for everybody. You're automatically insured. And there's no individual longevity risk. So if you live very long, you still get a lot of payment, you get your regular pension payments. If you live very short, you get, of course, this for a shorter period, but the longevity risk essentially is covered. But of course, there's a demographic risk, as we see in many countries, as the population growth goes down, who is paying for this in the long run? If you have a funded system, on the other hand, it can be very complex, in particular if you have a lot of choices, and it can be also costly, provided by, financial firms take a lot of fees out of that. And then the question is, how should we channel the funds? Where should the funds channel to? If you have should it be funded to particular stocks, or should it be funded to more ventures and so forth? How risky can you channel them? But of course, the advantage is, and we see that if you have it channeled to the capital markets, to more risky ventures, you can also have some venture ecosystem, which actually leads to more innovation in the economy and more aggregate growth. And we see that in the US, there's a lot of funding, a lot of savings is channeled to ventures, which create a lot of innovation and growth, while in some European countries, you have more pay-as-you-go systems, dominated by pay-as-you-go system. You don't have these huge ventures and innovations going on. But in any case, how the funding, if you have a fully funded system, so it's in advance, you save it and then invest it, you can also have through indirect participation via insurance and pension systems, you actually have a possibility to actually participate in this equity premium you can earn, which you cannot to some extent when you have a pay-as-you-go system. So with these few thoughts, I would just, saying, okay, we have to some extent, we have to think about how much should we open up the choice set for individuals, and we should also think about the staggered participation and the pay-as-you-go system versus the funded system. That has implications more generally for the broad economy, to what extent the economy can be driven by innovation or not. So let me leave it at that. So we are looking forward to get a peek into the new book, which is available already now. It just came out last week, it's my understanding, on personal finance and how to make it work for everybody worldwide. Thanks again, John and Tarun.
Okay, wonderful. Well, thank you very much again for inviting us on. It's a real pleasure to be here. I mean, especially having seen so many of these wonderful talks before. This is the book, which was just published, as Markus pointed out, on October the 21st, 2025. And so let me sort of get into it by starting out by telling you a little bit more about why we decided to write this book in the first place, and why we decided to write it at the moment, right now. We start the book and also actually end the book with the stories of these five people. And these are anecdotes, but we really believe that this is a far more systemic issue. So ordinary people routinely have really terrible encounters with the personal finance system. So I can sort of summarize a few of these stories, which will give you an insight into how bad these encounters can actually be. So we start off with the example of Renata Keynes, who is in the US, goes out there, tries to find a college, finds one to try to become a teacher at the age of 17, has very little understanding of the fact that when she takes on an enormous amount of student debt, that the debt has to be paid off at some stage at an interest rate that is pretty high. She then finds the cost unmanageable, moves to New York, makes that cost even more unmanageable because, of course, the cost of living is particularly high in New York. Does a succession of odd jobs, really striving to get the education that she wants. And 10 years later, at the age of 26 or 27, she finds herself back in Boston with no degree and saddled with $65,000 of debt. Another story we tell is George Maddox, who was a plant manager at Enron, invests his entire retirement savings, has a really big nest egg of $1.3 million in the US, invests all of it in Enron. This is a classic finance mistake, which is being completely undiversified, has no idea that the bankruptcy is coming, but of course, as we now know, it did, and then has to end up moving out to a sort of ramshackle home in Texas with his wife and mows lawns for a living to try to really make ends meet at that stage. We also tell the story of Ruth Putnam, who tries to retire on money market interest because she is really terrified of stocks. She basically goes out there, buys, bonds and certificates of deposit, and then as interest rates decline, finds her income dwindling substantially and starts to sell off her priceless China collection piece by piece. This has enormous emotional value for her. Now, the book takes an explicitly international perspective. And so, as we say in the book, the US has no monopoly on stories of this nature. We tell two stories of mis-selling, one about Simon Shipley, who was for years sold payment protection insurance for a mortgage he takes on, as well as three other loans. This is bundled. He doesn't even know he's purchasing it. As it happens, many years after the fact, after he keeps paying it, he realizes that he would have been ineligible to claim anyway on this payment protection insurance because of the fact that he had a pre-existing health condition. He does get some remuneration because there's a class action suit that the Financial Conduct Authority actually pushes through, but there are many others in his position that are not compensated. And we quote, and he says he's amazed at how long this was allowed to go on. Another story from India is from the unit-linked insurance plan scandal, and in this particular case, Virendra Pal Kapoor is sold bundled insurance product that's supposed to be an asset management product, or at least that's what he's told by the state-owned bank that he sold the product by. 5 years later, 99.5% of his initial investment is gone in expensive premiums. And, as he keeps trying to find information about this through the journey, there's constant obfuscation. He has to take them to court, gets a high court judgment in his favor. And as we speak, the high court judgment is being appealed by the provider. So, these are stories where you kind of look at these stories and you think, gosh, that's pretty terrible. And then you might well imagine that the level of income that you have also determines how awful these stories might be for you, because obviously you could have your entire retirement savings nest egg wiped out. You could have situations where, an outlay for an asset management product is basically again wiped out in bundled insurance. And these things can be tolerated by people who are wealthy, but can be extremely material for people who have lower wealth levels. Now, these problems, we make the argument in the paper, are not just anecdotal problems, they are systemic problems. They are systemic problems because they're incredibly widespread. These stories are not just, one-offs. They occur not just in those areas of the financial system that we've talked about, but across the financial system, as we discussed in the book. And they're also growing in scale as more people around the world are asked to solve more and more difficult personal finance problems. Obviously family structures are changing around the world. People are no longer living in joint families. People don't have sort of communities that are able to provide them with insurance of various different types. They are living longer. Their retirement periods are stretching for longer periods of time. Expensive housing. There is education that is substantially more expensive than it used to be. And so the financial problems are increasing day by day for most of these people. And as I've already referred to, they perpetuate inequality. Why? Because these problems hit the poor more than they do the rich, or at least the relatively poor more than they do the relatively rich. And so, as we argue in the book, can really exacerbate inequality. That is to say, if you have small differentials in the rates of return that you earn on assets and the rates of interest that you pay on debt, because of the power of compounding, as we all know, these problems can be really, really material in terms of exacerbating the divide that might already exist in society. And as we know, inequality has multiple dimensions to it. We're now experiencing electoral dimensions to inequality as well. So there are some political economy consequences to this as well.
But
Now,
there are
the
also
other
some
point,
causes.
yeah,
Just
go
to
on.
ask a question about
Mhm.
now it's easier to participate in mutual funds through, the mutual funds since the 70s, 80s became much more prominent. So it was much harder, let's say in the 50s and 60s, to participate in the
Mhm.
stock market than it
Yeah.
is now. So there's also good developments in a sense. Would you agree with that?
There are good developments, but we make the argument in the paper that you can also replace one problem with the other, which is to say, imagine that you have a situation where you can now participate easier in the stock market, but at the same time, the complexity of participation still exists and can result in you destroying wealth in that area. So you could be terribly under-diversified, even though it is the case that low-cost vehicles are available that provide diversification. There are some index funds that have very low cost, which might be 10 basis points, but there are other index funds that have 2% fees. And if you're not careful, you could invest in the wrong index fund if you don't shop appropriately because of the bundle fees or the expense ratio in those funds. And, people have a tendency to focus on the benefits, but they neglect the costs, and in the long run, the costs of financial services can be extremely important. And so we make that point in what I will say in a bit. But so now the other point that we make in the book is there are lots of books out there that are talking about extreme poverty and alleviating extreme poverty, and there's also lots of books that are focusing on the other end of the wealth distribution, the extremely wealthy. And both of those types of books are very important, and we sort of believe that those are both important and interesting constituencies to consider. But one of the things that we feel about this book is that the book affects is about the global middle classes, and we believe that they're an underserved constituency. Because the middle classes also sort of constitute the median voter, And this can contribute to the widespread unpopularity of finance, these issues with personal finance, and even ultimately can threaten support for the institutions of a market economy, which really is the best system that we know of to create sustained prosperity. So just a couple of quick figures to illustrate the scale of the problem. On the left-hand side, which I'll focus on, are sort of two interesting income pyramids. These are really the x-axis here just show you the number of dollars per day earned by populations around the world, which are illustrated in different colors. Red is Asia, blue is Africa, green is Europe, and yellow is the Americas. And the vertical line in each of these plots is showing you the position of the World Bank's poverty level. This is the absolute poverty level. And these are in 2011 inflation adjusted, PPP adjusted US dollars. Okay, so anything to the right of that vertical line is sort of people above the absolute poverty line. And you can see that in 1975, which is the upper pyramid, there was a sort of two-hump distribution, a bimodal distribution. And since then, over the last 40 years to 2015, you see that a huge number of people have moved to the right. So you can see there's enormous economic growth that's happened in Asia that has transported people out of poverty into the middle classes, and the global middle classes have been growing. So there's now a single hump distribution for the most part. And so there's lots of people who are sitting in here who are just encountering the modern financial system and are able to use it even at small scales. And so those first encounters, we believe, should be extremely carefully managed because those are the periods at which people are most vulnerable. They are precarious. They can be pushed back into poverty. But it is also the case that those first defining encounters are the things that determine their trust in the financial system. So it's really those sorts of things that we think are systemically potentially.
So if I look at the green one is Europe, because the double hump
Yes.
really comes from the green aspect. There's a shift towards to the right, but the double hump is a European phenomenon. How do you
The
explain
double
that?
hump is not just the European phenomenon, it's also, as you can see, an Asian phenomenon largely, because the big red bit over here is really Asia. But yes, it's everywhere, and you can see that in Europe as well, because these are overlaid, you can see that it is moving to the right also. So that bimodality is decreasing everywhere, but the rate at which people are being transported out of poverty, the big story here is Asia. Another reason, by the way, why the global dimension of this book is important to us, because if you are counting people, then there are so many people around the world, and we should be equally aware of all of them in some sense. Now, the right-hand plot, which we think is also an important one, is taken from Laurent Bach, Laurent Calvé, and Paolo Sodini's 2020 paper in the American Economic Review. And this shows, using very detailed data on wealth in Sweden over 2000 to 2007, so the x-axis here lists the percentiles of the distribution of gross and net wealth. I will tell you which is which. So these are the sort of the lowest wealth people on the very left, and these are the highest wealth. And you can see that it's not just 10, 20, 30, 40, but on the right, there's this sort of almost fractal way of thinking about it, which is you go from 90 to 95, 95 to 97.5, 97.5 to 99 percentile of the wealth distribution. So these are the really extremely wealthy as you move to the right. Now, what's interesting about this plot is if I look at the mean excess return on gross wealth over the risk-free rate, you can see it's kind of monotonically increasing as you move to the right. So basically, using these very detailed records, they're able to show you that wealthy people are actually, earning much more on their assets, okay, as you move to the right. Now, the gray line shows you that wealthy people are also paying much less on their debt. As you move from left to right, from about the 10th percentile to the extreme right, you're seeing that the amount of return interest that they're paying on their debt goes from about 7% on the left-hand side to about 1% per annum on the right-hand side. And so when you put these together, the blue dashed line is the mean excess return on net wealth, which is gross minus debt. And you can see here that it's actually monotonically increasing. So,
Do you have a graph which is risk corrected in a sense? There might be a lot of idiosyncratic risk in the very wealthy ones, and they get compensated for that.
absolutely. And in fact, it is partly because of that idiosyncratic risk that you don't see it going all the way up towards the very end of the distribution over there, because there's large investments in private assets as you move to the right, which carry enormous idiosyncratic risk. But it is also the case that you can see that even with that idiosyncratic risk, the average return is increasing to the right. I mean, it is true that if you were to look at this not in terms of arithmetic average returns, but in terms of geometric average returns, which actually capture that risk effect that you're talking about, we've done work in India, John and I, with Ben Ranish, that shows that actually the same pattern is true, and it can explain almost all of the differences as you in the rate of return on stock investments in India. So actually, even accounting for the risk, you can see that there's big differences as you move from left to right, and in fact,
Can I ask
Bach
a question
Chaldeans.
about the gray line, the cost of the
Yeah.
interest burden
Hmm.
of debt?
Yeah.
It seems like it first goes up. Why does it first go up and then it goes down? That the increase
Right.
is
So this is a
surprising.
little bit of an artifact. So you have to sort of dig in the online appendix to their paper to describe, to explain why this is going on. But it turns out that they explain it in two sources. One is that they claim that there's some mismeasurement at this extreme left percentile of the distribution. But then the other reason is that they claim that there are some people who potentially um, actually took on investments in debt that potentially were sort of the rate of return was low on debt, but they invested enormously in assets that were actually underperforming. So these are sort of negative net wealth people that are at the extreme left of the distribution, is what they're talking about. So even if they did borrow at relatively low rates, they invested in really unproductive assets with those low rates that they invested in. So in some sense, they are at the left-hand side of the distribution because of the fact that they screwed up in the way that they invested. Okay. So that's sort of, they claim that there's about a 50-50. Yeah, I was equally puzzled by
Okay.
that. So, but really the big story is as you move
Yes.
from
Okay.
10 to 10 up. Okay, now I'm really going to just spend most of the time that I have left, which is not a lot, because I definitely want to give John a chance to talk about the rest, to sort of describe this. Part one, the problem of fixed financial system, and sort of diagnose the problem, and then I'll hand over to John to talk about some specifics about what goes wrong in personal finance, but also the solution that we propose in our book. So, where we start is in some sense related to another webinar that I think you just had recently with Alex Imas and Richard Thaler, which is why do people find financial decisions so difficult? And here, our we rely quite heavily on behavioral economics and behavioral finance, which we believe has lots to say about the way that individuals make decisions. And this bears repeating, which is that in finance, human intuition is only going to take you so far. Okay, so it is true that our brains were have evolved to say that when you add one wolf with a second wolf, there are two wolves. So we could certainly do those kinds of calculations even with our primitive brains. But in order to look at finance, we need to do cold, hard, rational calculations about things that are very, very difficult. And we're all in the profession, so I think we know about this. But it's worth sort of mentioning the fact that, for example, we really anchor. So the context, is something that we are sometimes neglecting. So if someone says, I'm going to give you a 15% discount, then you sort of anchor on the idea that there's a 15% discount without necessarily thinking about whether the 15% discount is applied on $100 or $100,000. And of course, a 5% discount on $100,000 is much more material to your well-being, but perhaps you're fixated on this number. We also, as we've seen recently in the pandemic, we fail to understand exponential growth. That because in finance it requires repeated multiplication. So just going back to this plot over here, this is a per annum rate, and these differentials look okay. What's the big difference between a 7% and a 2%? And the answer is if you repeatedly multiply 7% and if you repeatedly multiply 2% over many years, that's everything. That's more than the initial outlay that you put out there, and that's really the big story. But we sort of fail to intuitively understand that exponential growth. We extrapolate from small samples. So when we see that a mutual fund has hit it out of the park with a 10% return, we tend to think that they're fantastic, or even a 20% return. I used to study hedge funds. There, the numbers were even more eye-watering. And so, we don't seem to really understand that it's possible that they just took leverage and they took on, risk over those periods of time. And it would take a long time for us to really understand whether they actually had alpha. Of course, that is exacerbated by our own personal experience. So Stefan Nagel and Ulrike Malmendier have some excellent work on the idea that, if you lived through a period like the Great Depression, then you really that influences the entire character of the way that you approach financial decisions later on. We have a tendency to neglect base rates. We potentially apply Bayes' rule, but then we are very, bad at sort of understanding that if an analyst is, for example, seemingly 100% or 90% accurate about doing things and recommends that a venture capital investment is going to be really fantastic and he has 90% success rate, well, we neglect the fact that 99% of venture capital investments are actually going to go, very badly, and really it's the 1% that do very well. We might expect that reinforcement learning is going to help us, that, we can learn by just repeatedly experiencing bad things that sort of push us away from bad stuff and push us towards good stuff. But the problem in finance is the outcomes can sometimes happen many years after the fact. They're very, very delayed. Sometimes, of course, we don't even have reinforcement learning opportunities, because how many times in life are you going to buy a house or take a mortgage? Some of the biggest decisions we make are decisions we make extremely infrequently. The other thing is, of course, there's enormous uncertainty because of the nature of financial markets. And of course, we have this tendency to confuse luck with skill, as the example of mutual funds will demonstrate. Now, you might then wonder that social learning might help you. Maybe you can learn from your friends, but the problem is that in the cross section, it is very difficult to learn. Even if you have hundreds of people that you speak to in the same period of time, they may all experience a common shock. And so it's very difficult for you to disentangle things, because you need a time series to tell you about what's going on. And even if people are prepared to give you honest feedback or tell you exactly what they're doing, even if you're able to discover people who are around for long periods of time, so the correlated shocks problem is not there, you're going to get a biased view, because people really don't seem to talk very honestly about money. They're happy to tell you about their successes, but they're very unhappy to tell you about their failures. And so again, you get some biases.
So where would the phenomenon of FOMO, fear of missing out, come into? That's part of the people
Yeah, no,
confuse luck and skill,
absolutely.
or is it more like the social learning component?
Yeah, no, I think FOMO is exacerbated by social learning, right? I mean, I think if you can think about the fact that if you go talk to your neighbor and your neighbor tells you that crypto has done fantastically and their portfolio has made them 3 times wealthier than you could possibly ever be, you didn't talk to your other 2 neighbors who may not any longer be your neighbors, because they had to move out of the neighborhood and sell their house because they lost everything on their crypto investments. And
Yeah.
so in that sense, your FOMO is exacerbated by the people you talk to, not the people who refuse to tell you about their failures. Now, of course, temptation makes it very hard to do the right thing, even if you know exactly what the right thing is to do. So, we have this tendency to have present bias. We have this tendency to want to save, but then when the time comes, then there's an opportunity to splurge, we will splurge. The emergency savings nest egg that we have sort of painstakingly put together is the thing that might disappear and not be available for you at a time of need. Now, we sort of summarize this in the book by saying that the way we want to sort of characterize the ordinary people's approach to financial decisions is that they are such a hassle, they take such a difficult amount of calculation effort, that people can sometimes put them off for long periods of time and procrastinate. So they take them only intermittently. And when they take them intermittently, it's usually because there's an impulse of some sort that forces them to take this decision. And when they do finally have to confront the reality of taking a financial decision, they can sometimes act emotionally rather than rationally when taking that decision.
But you're proposing you should limit the choice set for individuals in a sense, or
Yeah, I mean, I mean, I will let John sort of
no
talk
problem.
about the solutions. I'm still very much in the
Beyond nothing,
diagnosis
I
mode.
guess. So
Absolutely. So let me just sort of say that the other thing, of course, that you might worry about is that, or you might say as an academic, is that, well, maybe competition solves these problems. Maybe the competition in the financial sector is going to deliver you the highest quality products at the lowest possible cost. And there's so many people in finance, there's so many institutions out there that perhaps they are happy to sort of, make the world a better place. Unfortunately, we actually point out that that's not the case. The difficulty of finance translates into people misperceiving the benefits, as we've already discussed, misperceiving or not even perceiving the costs, failing to search for financial products, and once they actually have these products, they mismanage them. And actually, we believe that competition in this case is pernicious. It is perverted. The finance sort of becomes corrupted because we are incentivized to supply the products that people demand rather than those that objectively serve people's interests. And so, you had the specter of when medical sciences were unregulated or medical products were unregulated, doctors were openly advertising that you should smoke Lucky Strike to solve your throat problems, right? I mean, even though they knew full well that this was not particularly good for you. And so instead of competing to reduce prices and increase quality, there's a lot of rent-seeking behavior, and there are markups because of people's inability to make rational financial decisions. So there's unproductive competition. You can see this in the US, the spectacle of many bank branches, which is sort of wasteful effort, or the fact that realtors crop up in places where there are real estate booms to try to sell you stuff that's overpriced. And it gets even worse because there's evidence that suppliers are out there to try and make things more complex, to bundle products, to make comparison shopping even harder. And so now you can sort of really get into some trouble. This is, of course, the field of study that we know in economics is behavioral industrial organization. Now,
What's
the thing is,
special about
sorry.
finance in the sense you're saying it's similar to the health component? If I want to buy a mattress, they make it very hard to compare across different mattresses as well. So it's in many other products as well. But you would say finance is particularly different because you
Yeah,
have so
I
much
think
leverage over your decisions make such a huge difference in your life.
so. First of all, you're absolutely right. It's the scale, right? So it's the fact that in finance, you sort of have it as a touch point. So even when you're going out there and facing behavioral industrial organization problems in the real world every day, you have to go through the financial market in order to get to those problems. And so, it's almost kind of you face it everywhere. It's ubiquitous. Even in markets when you don't necessarily face it in the goods market, you're going to face it in the financial market because you have that touch point anyway. So that's definitely one problem. But the other problems are that because financial calculations are specifically so difficult, and because of the fact that you incur the costs sometimes and the benefits come many years in the future, and the fact that we have this difficulty of confusing luck with skill, that you have specific issues in the financial market that make it even more of a venue where these kinds of problems occur and occur repeatedly. Um, I mean, the other thing that I should just point out, and I think this is an important point, so I'll spend a minute on this before I hand over to John, is that, another solution to this is, well, people could just be financially educated and learn to be savvy, right? So maybe there are some people who just, haven't really understood the fact that you need to shop for financial products and to do it properly. And so you might then sort of feel a sense of deep satisfaction about finding a great deal until you realize that sometimes, and very often in financial markets, the good deal that you got is because somebody else has got a bad deal. There's a sort of a zero-sum flavor to this, and there's an implicit regressive cross subsidy that's out there in the marketplace. And you can illustrate this in a number of different ways. I think one sort of good way to sort of describe this, I'll give you two examples, one from my own work and one from life insurance. But from my own work, I mean, in the United Kingdom, there's a very simple structure. There are teaser rate mortgages, which have extremely low rates for a short period of time, which are fixed periods of time, maybe 2 years in the first instance. And if you don't very promptly refinance on the expiration of your teaser rate deal, you get rolled into a standard variable rate that is many multiples higher than the original rate that you might have paid. Now, if you're very smart about just sticking it in your calendar and being very religious about immediately refinancing when it is, when the teaser rate expires into another teaser rate, you'll be just fine. But it turns out that, if you do the calculation, anywhere between, depending on the year, 15 and 35% of the entire UK mortgage stock is paying standard variable rates, which are many multiples higher than the teaser rate. And this is an enormous sum of money that is just being transferred because of the fact that people are inattentive to the fact that they have the opportunity to refinance their mortgage and are just not even thinking about the fact that this stuff is being debited.
Do you think in the future an AI agent will take care of that? I mean, you have a whole chapter, I think, on fintech and future technology. Do you think that will
Yeah,
still
no,
solve this issue, or?
absolutely. This is a great question, which is it the case that technology is going to solve these problems? And I think John will spend some time talking about this. And I think, let me give you a sort of a quick response to that, which I think John will elaborate on, which is that we are worried that technology is dual use. Okay, it can, if you're lucky, technology is going to do all the wonderful things you want it to do, but we're not the only people who have access to it. The supply side also has access to
Yeah.
it. And so there's a question here about who wins. Okay. The other example of a cross subsidy is that, and so just to sort of finish the point about the cross subsidy there on the teaser rate mortgages, because 30% of the mortgage stock is paying the teaser rate, paying the high standard variable rate, that's why you can keep the teaser rate so low for the prompt refinances. And so in some sense, there's a sort of a regressive cross subsidy that's flowing there. In life insurance, if you forget to make your payment or you can't keep up with your life insurance premium payment, then it just lapses and it just disappears into the profits of the insurance company. And then they can use that to keep insurance premiums low for the rest of the non-lapsing population.
So
And
you
very
argue
often, yeah,
initially
go on.
that there is a redistribution. In a sense, wealthy people get a higher return and pay a lower interest on their debt compared to poor people. But I could also argue, right now you argue there's a redistribution across subsidization from the less financial literate to the more financial literate. So can I split the two things apart about financial literacy and wealth? Of course, there's
Yeah,
a
it's,
that more
yeah,
financial literates will be typically more wealthy.
yeah.
But can I separate these two channels?
Yeah, you can absolutely separate those two channels, but as you correctly pointed out, the sad reality is that the correlation between financial sophistication, wealth, education, income all goes the way of making this be even more regressive. In some sense, some of the differentials that you're seeing in the plots that I showed you are because of the fact that the poor are essentially through a cross subsidy subsidizing the very rich and that's what's contributing partly to that slope. And when you see that, it's a very uncomfortable fact. It doesn't sit very well with us when we sort of think about the way that this is going on. Now, of course, if you're a financially unsophisticated person, perhaps you could just delegate. But the problem is the delegation has its own set of issues, as we all know. There are conflicts of interest. It is something that you may not perceive as a person who is a little bit less educated or lower income, or you may put your trust unthinkingly in a person who can take advantage of you. But the big issue is when you finally figure it out, then there's a lot of anger, there's a lot of mistrust that goes deeper. And so in some sense, this kind of undercuts the entire finance project in a sense. The fact that we want more financialization of the economy, we want things to work a little bit better. Okay, so the last thing I'll say is that one alternative that people seem to be thinking that they will do is they just jump out of the situation altogether. Let's abandon formal finance. Let's get into crypto. Let's go do family and friends related stuff. But it turns out that, there's lots of evidence of this, that those alternatives are all much worse. And as you pointed out already, society needs formal finance to allocate capital efficiently. And so we need people to trust the financial system in order to do that capital allocation problem. Okay, so let me stop here and hand over to John.
Thanks, Tarun.
Yeah, thank you.
So, Tarun has taken you through part one of the book, which is our diagnosis. I'm going to only very briefly mention part two, which is where we dig into many of the details or the specifics of what goes wrong in personal finance. And we define four broad areas. One is managing the short-term ups and downs of life, income bouncing up and down, unexpected spending needs, and so forth. That's about short-term saving, short-term credit. Then we've got a chapter on making large investments, where we talk about how you finance higher education and housing. Those are the two most important cases, we think. We have a chapter on living with risk, which is where we talk about investments, equity market participation, diversification, all of those sorts of topics, and also insurance and the management of insurance products. That's a chapter where I will say, fools rush in where angels fear to tread, and we try to use expected utility theory in a non-academic book to explain many of the principles of risky investing. I certainly won't go into that here. And then finally, chapter 7 is about securing retirement. It's about the life cycle. How much should you save for retirement, and how do you run down your wealth in retirement in order to support a good standard of living. So I'm just going to show you 3 slides to sort of summarize all of that, but without spending significant time on it. But, you know, in terms of managing the ups and downs, one of the main points we make, and it's illustrated in this figure at the right of this slide, is that so many people in countries around the world really have very little liquid financial assets. So using survey data, the figure shows the fraction of households in each of these countries that have liquid financial assets that are below 3 months of their average consumption. So that's below the emergency fund, even the smallest emergency fund that is normally recommended. And in the US, that's about 40% of households. In the UK, it's over 50%. Germans do a little better. Congratulations there, Markus and Germans. But, you know, in emerging markets, the problems are even worse. And the extreme case here is South Africa, where almost no households have that much consumption. Of course, you may therefore need credit. Do you arrange it in advance, or do you have to, you know, get hold of credit and borrow when the need comes? All too many people have to organize credit on the fly. That kind of credit is very expensive. And we also talk about debt traps and the way in which people fail to manage the situation when they get into debt traps. So then we go on. As I mentioned, we talk about large investments and risk-taking. This is chapters 5 and 6. We make the point, which is very well known, that non-participation in equity markets is surprisingly common. That makes sense perhaps for people at the lower end of the wealth distribution who don't have very much money to invest. But it's surprising, as you see in this figure at the right, as you move through the asset distribution from the low asset households at the left to the high asset households, the wealthy at the right, the line representing equity market participation, which is the yellow dashed line, rises surprisingly slowly. And there's a surprising fraction of households who really have substantial assets who still don't hold equities, even in retirement accounts, not through mutual funds, not through any means. We regard that as a problem. Then we talk about funding, housing, and higher education. How do people judge the cost and return of higher education? How do they choose a suitable repayment plan for repaying their student debt? How do they avoid the kind of problem that the young woman Renata Keynes, who we mentioned at the beginning, she got into that? How do you stay out of that trap? Then we talk about mortgages, and this is a hugely complex area that we've both done quite a bit of research on. And there are many, many traps at every stage. Choosing a mortgage, deciding whether to take points within the US system, and of course, all the decisions surrounding refinancing.
The mortgage market is very different from country to country.
It is extremely different. And that's something we're going to come to at the end, that we very much recognize that countries are different, and we're not trying to force every country into a single mold. We actually think it's likely that the UK will remain a primarily adjustable rate mortgage country, and the US will remain a primarily fixed rate mortgage country. But we think that in each case, the product design can be improved and simplified while remaining within the tradition, if you like, of that country's financial system. The last detailed
Point to home ownership as well, in a sense that, you know, the mortgage market determines also to what extent how high the home ownership rate is as well.
Yes, I mean, the availability of mortgage finance is certainly very important for home ownership, but there are cultural differences there too. Countries with more apartment buildings tend to have more rental ownership, and some countries, such as the UK and the US, have a strong home ownership culture. Other countries, like Germany, far fewer people own their homes, and People are much more comfortable with renting. So we don't know that there's one size. We don't think there's one size fits all. But within each of these systems, we think going for simplicity and minimizing the traps is the important principle.
Yes.
We've talked a bit about the retirement challenge already. We highlight the inexorable trends of the aging population, the smaller families that people live in, the shift from DB to DC retirement plans so that people have to manage their own assets, and until quite recently, the low real interest rates that made it very hard to fund retirement. We describe the evidence that people on average don't save enough. The lower figure at the right is sort of the wealth income ratio in the US on average in different years. Those lines slope up as people do accumulate retirement wealth, and they bounce up and down from year to year depending on the level of stock and housing markets. But even in the good years, people don't hit what is commonly described as a wealth income ratio of 6 at retirement and perhaps 4 at age 50. And those lines in that figure never get there. We also talk about problems in retirement, the reluctance to annuitize, the so-called annuity puzzle, and the fact that you end up with people who are house rich and cash poor. Another aspect of mortgage finance is elderly people who own their houses but don't have enough to live on. So
people say that annuitize is very expensive. It's not a favorable deal what the market offers. Do you agree with that, or?
We agree that these markets are trapped in a poor equilibrium where products that might be quite advantageous, like reverse mortgages and annuities, have high marketing costs because people don't understand them, people are reluctant. So high marketing costs, too small a market share, and they're not sufficiently well standardized. And so this really leads me into our approach for trying to ameliorate some of these problems, which is to use the power of government to design standardized products that then will be easier for customers to understand, cheaper to market, which will lower their costs, and easier to comparison shop for, so that the force of competition will work better to keep down costs. And we think that in a number of products, including annuities and reverse mortgages, this could really help. So that's going to lead me into the last part of the book, which I think that the live chat suggests people are keen to get there. It's easy to talk about the problems, but what are we going to do about it? So here's part 3, the solution, the last 3 chapters of the book. We start with technology, and we've emphasized that. I'm going to argue that technology isn't enough by itself. Then we have a chapter called Shove, which talks about the need to bring in the power of government to do something about these problems. But do what exactly? What are we trying to achieve? Well, that's in chapter 10, which offers a vision of a better financial system. So first of all, technology, and some other things that one instantly thinks about when talking about these problems. So technology, well, it's very meaningful and very important. A lot has happened already, and with the advent of AI, more is on the way. We have far lower fixed costs than we used to have. That means that small savers and small borrowers can be offered products at much lower proportional cost because the fixed costs are down. It's also true that you can use technology to search for products more easily. You can do comparison shopping on your smartphone instead of paying what used to be called shoe leather costs to pound the pavement to go around to different financial institutions. Products can be customized to clients' individual needs. This is all great stuff. The problem is the technology can also be used in ways that exacerbate biases rather than correcting them. So it's easy to target weaknesses. You can gamify stock trading. Or a favorite example of mine is that if you look at the Alipay interface in China, which is how many Chinese people buy mutual funds, it's going to show you on your smartphone screen a list of mutual funds in order of their performance in the last year. So whichever mutual fund has gone up the most in the last year is going to be at the top of the screen. Well, what are you going to buy? Everybody buys what's at the top of the screen. So it exacerbates performance chasing. There are other risks as well. We know that it's possible to price discriminate using personal data. It's easy for financial providers to use the trails that we leave on the internet to identify who's likely to be a savvy shopper and who's not. And you can offer higher prices to the people who are less aware.
So would you regulate, or would you say as a government should actually tell Alipay, we can only list the mutual funds in a random order, or what would the regulation?
What we want to do is have government design a set of standardized products that we ensure are available. Now, we call these the starter kit products. They are the basic, simple, easy to shop for, safe to use, easy to use financial products that should be the starting point for everyone. Now, that doesn't prevent, and we're not trying to have the government take over the financial industry and shut down capitalism. But what we want to do is provide a kind of base layer, if you like, that is the foundational products. We're well aware that there's tremendous appetite for speculative investing. One might say gambling. I would say gambling. There's appetite for that. And we're not proposing to try to shut that down, but we do think that should be separated from the means that people use to establish their basic financial needs, their financial security in life.
But when I design, the standard products, are also the details of the design probably favor one firm over the other firm.
Well, no, we
a lot of lobbying effort by the financial industry to affect the design of this. How do you control that?
We think that it's possible to come up with ideas for simple designs that are neutral in the sense that every firm can offer one of these. There's actually a very simple example from Germany, which we learned about, called the Basiskonto, which is a very basic bank account that anyone in the EU, any legal resident of the EU can get one of these accounts, and it's a very, very simple, basic, plain vanilla bank account. But every bank has to offer this, and we think that's a simple example, but one can push that idea further. But before I get to that, let me just mention two other things that people often think about. One is financial education, and it's common to have this response that, yes, there are all these problems, but let's just educate people out of it. Now, I do want to say I'm very much in favor of financial education. I've recently joined the board of the Council for Economic Education, which is a non-profit that promotes both economic education and personal finance education in this country. And I'm very committed to that. I also, teach a personal finance course at Harvard College. So it's a great thing. But we don't think it's sufficient. And there's a couple of reasons. One is, if you think about people getting their education in high school or even in college, 5 or 10 years later, the financial industry will have evolved. There will be new products. There will be new tricks and traps. Even the terminology will have changed. So it's a continually moving target, and it's very hard to equip people with everything they need to know over a lifetime. Secondly, particularly in high schools, I think there's the problem that high school students are not yet making many of the decisions that they will have to make. Yes, perhaps they're taking out a student loan or even getting a credit card, but they're not getting a mortgage and they're not saving for retirement. So it can be rather abstract. And, if you imagine driver's education, how effective would that be if it was only the classroom component and not the actual road getting behind the wheel and driving the car? I don't think much would stick. And there is that danger too. So yes, we should do financial education. We should push hard on it, but it isn't a sufficient solution in itself.
If you look at the race between how more complicated the financial system is becoming over the years and how much more financial education can happen, where do you see which one of the two horses will win?
Well, I would say that complexity has been winning, and we need to slow down the growth of complexity so that financial education can have a chance to catch up. That's what I would say. Now, nudges, of course, is another famous solution. Here we're referring to the famous Thaler and Sunstein book, Nudge, on suggestions and defaults. And these, are very popular because it's such a light touch intervention and it really doesn't damage anybody. Anyone can opt out if they don't like the suggestion or default. The problem, we think, is that the early evidence of striking results was concentrated on short-term impacts as opposed to the long-term ultimate impact that you want to get. So it's one thing to get people to sign up for a 401k plan, but what you ultimately want to affect is their retirement wealth. How much money do they have when they retire? And that's much harder to influence. As we've studied this over longer periods, we've come to learn that the effects often fade over time. And there can also be unintended spillover effects. So, for example, you might be automatically saving more in your 401k, but you might be accruing more debt outside your 401k because you're not cutting your consumption enough. So, again, nudges we think are very useful tools, but inadequate on their own. And so, what do we think we should do? Shove. What does a shove mean? It's a more vigorous intervention. We do mention, of course, that government should not forget the basics, things like providing financial infrastructure, designing, clear disclosures that people can follow, creating a means for consumers to complain so that one can learn where problems are. We actually think the CFPB's complaints database was a very valuable thing and a bad thing to shut down. But beyond that, we think that consumer financial protection regulation is a good thing. It should be coordinated by an agency that has this responsibility, such as the CFPB or the Financial Conduct Authority in the UK. Mm-hmm. And government has tools that can be used to change prices, taxes, subsidies, even price caps, although we think those should be used very cautiously. Tools to change the cost to providers, for example, by providing a safe harbor against litigation, which reduces costs, and also to regulate product access. So we think, we've got to be more aggressive. It's not enough to nudge. You've got to actually shove. Now, what does that mean concretely? But can we get a little more specific? Well, we have 4 themes that we think should be pursued. One is that you can fight biases with biases. Now, actually, the basic nudge, the auto-enrollment, is doing this. It's fighting the bias to procrastinate with the bias to procrastinate by putting you into a retirement account automatically. But we think there are other ways to do this. For example, to create savings accounts that align with people's savings motivations, their mental accounts, if you like. Or to use prize-linked savings and exploit the popularity of gambling to get people to actually save for retirement. We think a second theme should be to curb market power, require product offers to be standardized, and regulate the units in which prices are quoted. Now, that type of regulation is long-standing. You have to quote APRs in this country. And that's been true for almost 60 years. But one wants to think very carefully about what these units are, and in every part of the financial industry, make sure that understandable units are used. A third theme should be to clamp down on conflicts of interest, so impose fiduciary duty on financial advisors. And here I'd like to go back to a thing you brought up, Markus, which is the idea of an AI agent. Is that going to just solve all the problems to have an AI agent? Well, we have a thing in economics called agency theory about the problems with agents. And the problem is, in whose interest is the agent acting? And how do you know? And who pays the agent? So are people going to actually pay the electricity and training cost to make sure that the AI agent is working for them as opposed to whoever is paying the bill? And I think there are really deep questions here, and I don't see them being solved without some form of social action to create a legal framework for that to be reliable.
So what of these elements has to be done by the government, and are there some elements which can be done by an industry association through self-regulatory organizations?
Yes, I think there's absolutely room for that. Although I would argue that self-regulatory organizations often operate effectively because they are actually trying to fend off more intrusive government regulation, and it's actually the threat of government regulation that lends wings to the activity of the trade association. But yes, I think self-regulation can be effective, so long as the industry has the incentives to do it.
Some other thing is, can you imagine a setting where different states within the United States have different frameworks and people can opt in and out, so you essentially have competition across, I can use the Massachusetts way of saving because it has this standardization across the products. Do you see an opportunity there, or do you think that's more balkanizing the whole world too much?
Well, there certainly are spheres of the financial industry where state regulation is dominant, insurance most obviously. I'm not sure that works so well, actually. I think you get a race to the bottom. You get the industry exploiting the variation across states, for example, by setting up captive insurance, captive reinsurers in lightly regulated states. So I don't think it's ideal, but on the other hand, it may be something that happens in the current environment, and it might be better than nothing. But that would not be my first choice. Let's put it that way. Yes. Now, I don't want. Let me say one more thing. We think that automation of financial decisions is a very promising direction. This is an era where, self-driving cars are turning up on the road, right? And, we had a ride in a Waymo in San Francisco in January, and that was a wonderful experience. You took me for a ride, Markus. And if we have self-driving cars, why not self-refinancing mortgages? Or why not target date funds that are even more sophisticated than what we have and that respond to how much you've saved and not just your age? So there's a lot of potential there. I don't want us to come over as heavy-handed, never saw a regulation we didn't like kind of people. So we have two caveats. We think it's important not to make two mistakes. Mistake number one is to have a sort of backward-looking approach to regulation, which essentially tells the industry, you have to be nice to your customers. We're going to define what that means, and we're going to define it retroactively. So we'll come along, we'll look at what you've been doing, and if we think you weren't nice to your customers, then we're going to fine you, shame you, damage your brand. That has understandably provoked very, very strong resistance from the financial industry, and I can understand why. That's not actually consistent with running an innovative, efficient business. So we don't like that approach. And we also don't think the government should try to provide most financial services directly. Now, there are cases of efficient provision. The government, sends out social security checks very efficiently, and it runs student loans reasonably efficiently, not perfectly, but reasonably efficiently. But there are many, many examples of big government IT projects that have gone disastrously wrong. And finance is essentially a very IT-intensive business today. And so we don't think that government provision is normally the right answer. We want to stick with the competitive private financial industry that we already have. Okay, so those are some that we've been discussing sort of the things we want to do, but where are we trying to get to? What's the ultimate vision? And this is the last chapter called We Can Do Better. And we argue that we should try to design a personal finance system that follows 4 very simple principles. Now, I know they sound a little bit like 4 of Disney's 7 dwarfs, simple, cheap, safe, and easy, but that is the idea. If you make products simple, they will be easy for people to use. People will be less likely to make mistakes, so they'll be safer, and people will be able to shop for them, so they'll be cheaper. So there's an interaction between these things. What we'd like to do is design a set of products that we call the starter kit for personal finance. And we make the analogy with the sporting equipment that you should have before you even start playing a game in order to be safe and competitive. And in each category of financial products, we think that the firms active in that segment of the industry should be required to offer starter kit products. Of course, they can offer other products too, but they must offer these. And the design of these products should be standardized with price structures that people, the customers, can understand so they can shop on price. And furthermore, they can manage them easily after they've purchased them. There may be some cases where a product is so important that we should require people to choose one, but that will not always be the case. Finally, what might be some examples where we've got, the chapter is long, there's a lot of details, I'm not going to go into it all. I know we're short of time, but here are some examples. Think about simple transactions accounts. At the moment, people get very confused because they don't understand interest. And so they think it's a free checking account, ignoring the fact that it's not paying you interest. That is in fact the fee, but that fee is hidden. So we think transactions cost accounts should pay money market interest, but then subtract explicit fees so that people understand what they're paying for what they get. We've also learned, I think, that ordinary people find interest rates, even nicely standardized rates like APRs, surprisingly hard to follow. So we think that type of disclosure should be complemented by simple scenarios in which the dollar costs can be quoted. Lines of credit, we can work on those. We think that the key there is to avoid these sort of tripwire charges where a small overdraft triggers a big fee, or being late one day triggers a big fee. The fees should be continuous. And we also think credit should not be linked to spending as with buy now, pay later. It should be linked to the income that you're going to need to repay the debt. So paycheck advance, we're much more in favor of. Mortgages, there shouldn't be teaser rates on ARMs, and there shouldn't be points on fixed rate mortgages. Those are both traps and very confusing. Ideally, we'd like to see auto refinancing, but the low-hanging fruit is just get rid of teaser rates and points. We talk about assumability and portability. That's related to the lock-in problem that we've had recently in this country. That's a bit of a digression. Insurance companies, we need to ensure that they disclose information about their claims and their payouts. That's very important if people are going to shop on quality in insurance. Retirement accounts. We have this confusing abundance of riches, a profusion of accounts, right? We've got 401ks, IRAs, traditional, Roth, 429s, ABLE accounts. Now we have Trump accounts. They keep multiplying. But the profusion leads to confusion, and we'd like to see a single retirement account with automatic enrollment at the date of first employment. So these are some of the ideas. There's others in the chapter, but this should give you the idea. And let's conclude. I want to avoid coming over as a kind of impractical visionary, knock it all down and rebuild the city kind of person, like the stereotype of an architect from the 1960s. We do recognize different countries are different. economic fundamentals are different, the tax system, the state pension, the structure of the financial system, how much it depends on banks versus markets, and cultural attitudes about finance and the role of government. And of course, elections matter. They have huge consequences. So we don't really think that, there's a single vision for everywhere in the world. Instead, we think we want to paint a picture of a destination that we can all try to move towards. And the wheel of political fortune turns. It's in different positions in different countries. Maybe nothing very much is likely to happen in this country for a while, unless perhaps at the state level, as you suggest, Markus. Mm-hmm. But there are many other countries around the world that are struggling with these problems, and we hope that some actions will be taken that will move us in this direction, and that then, as people observe that we can do better, and we should watch other countries and see what's working and try to learn from best practices in other places and import them when we see things working. And, these problems are serious not only because of the consequences for individuals in their lives, the stories we started with, but also because the unpopularity of finance bleeds over into unpopularity of the market economy itself, and a loss of faith in the institutions that we depend on to operate the market economy. So we think you cannot neglect these problems, and it's time to start taking some action.
Thanks a lot, John and Tarun. Let me just ask you one big question in a sense. Do you see a country where you say, oh, this could be a role model for many other countries, that it's well done, or do you think it's actually across all the world that there's no well-developed financial system which serves everybody well? Can you pick a small country or some country where you say, oh, they're doing it fairly well?
Well, I would say, we've done some research on the Danish financial system, and it looks pretty good in many ways. Not perfect, but pretty good. Now, of course, a small Scandinavian country maybe has a simpler problem than many others. But I will also note that some emerging countries are leapfrogging the sort of legacy infrastructure of developed countries and innovating in ways that are very constructive. So one might point to, India's ID system, which is far in advance of the antiquated social security number system we have in this country. Or one might point to the digital payment system in Brazil, which is also very innovative. Or the use of mobile smartphone banking in some African countries. I think there's good ideas almost everywhere, but I wouldn't necessarily point to one country as the model that we just all follow.
Coming back on this leapfrogging idea, do you think the challenge is more to find the optimal system for a country, or the challenge is more the transition from the existing to a new framework? Because you will have some losers and there will be a lot of political resistance. Where do you see the bigger challenge of the two problems to solve, essentially? Is it to identify the optimal solution for a country, or to figure out the sequencing and the transition to a better solution?
Yeah, I think you're right about that, which is to say that, we have a lot of good technocratic solutions that I think we have put forward, or at least we're trying to summarize a lot of work. It's not just us. We're building on the last 2 decades of really excellent work in household finance in academia as well. So, I think research is sort of well ahead of the game in terms of these sorts of things. I think the implementation challenge that you mentioned is absolutely real. It's going to be first order, because you're quite right that we need to sort of, there's going to be all kinds of interest groups. You talked about the fact that there will be lobbying even for the simple products. Yeah. I remember when I chaired my committee at the Reserve Bank of India, which had a bunch of regulators on it, people were just turning up at various random points. I'd be at a social engagement and someone would shove something in my pocket and say, I think you really should look at this as a design template for something that you should be doing. And so absolutely those challenges are first order, and there are some questions here about, does that get subverted? Do you take the idea of the template and then do you sort of find it being suborned in a way that you was never your original intention? And I agree that that's a big challenge here.
So you also indicated essentially it's not only about have a fair system for savings and an efficient system for people to save in an efficient way. It's also about essentially saving capitalism. Is this a fair summary? Or saving democracy more generally, that people buy into our democratic society with a capitalistic system. So in this sense, it's a big deal. It's very important. It's the first order importance.
I think it is, and one thing we're really hoping, and appearing on Markus's Academy will surely help. But we're really hoping that this book doesn't get pigeonholed in the personal finance section of the bookshop, where there's lots of personal advice, and it's often good advice, but it's very niche. And we think this is a much bigger issue and should be framed in a different way, and that the book needs to be in a different part of the bookshop.
Big societal elements rather than purely how to invest as an individual.
Yeah, no, I mean, absolutely. Let me just add to that and say that, look, I mean, I think there's a sort of a telling in which personal finance is a self-help issue. And so everybody is sort of encouraged to go out there and get a bit of education and do this stuff. But I mean, I think our worry is that with so many people coming into the middle class and their first experience of the financial system potentially being one in which they're getting ripped off, is immediately something where, and then plus the cross subsidies where, you can sort of see that the rich are operating in a very different way than the middle classes or the poor. All of that together just really starts to destroy trust very quickly in terms of the people's personal experiences with the financial system being the touch point. And that's kind of really the bleeding edge of this issue in some sense from a financial markets perspective. And we really think that that's quite important.
But you would say the same design principles apply to an open society like the West, and also to a less open society like in China. You would say the fundamentals would apply the same way, or would you say if you're in China with Alipay and other things, you would actually design it differently?
Yeah, I'll say something very quick on that, and then I'm sure John has something to say as well. But there are two things. One is I sort of feel like in a potentially less open society, you don't see the problems until you absolutely see it right in your face. I mean, it's like the same issue can be bubbling underneath the surface in exactly the same way as it is in a non-open society, and it will just when it sort of hits the surface, it will explode like a volcano. And so, we actually saw some evidence of that with the adulterated milk scandal, or with the fact that the children's toys were not working very well. And financial systems, or personal finance is something that actually affects more people every day than either of those two issues, right? So we really do think it's universal in that sense. But John,
I think both in China and in Western countries, people are expected to manage their own financial affairs, right? So we no longer have any large economy anywhere in the world where it's kind of cradle to grave, you'll be taken care of, you don't need to make any decisions. So this is true everywhere. Now, the question is, what happens if things go wrong in either system? So in a Western country, suppose people, come to distrust large banks, the stock market, and so on. Maybe they're going to shift into gold, crypto, speculative investments of that kind. If in China people lose money, suppose the stock market falls, it's entirely possible that the government will decide that at all costs, to maintain the faith of the people in the system, they need to prop up the stock market. So they're going to override the market price signals and shift back to a more manipulated economy. That's going to be bad. So, but it's perhaps a different kind of bad than we might expect to see in a more market-oriented economy. Although I will also observe that the distinctions between these systems are starting to blur in a somewhat alarming way. So it's not quite the black and white type contrast that we might have thought a few years ago.
But you also fear that essentially, there's new financial law instruments appearing people make a lot of profits initially and then push it onto the general public. And if something were to go wrong, the government essentially has to bail out the whole new financial instruments. This phenomenon is always there. So to
Yes.
control that, how you have to ex ante essentially through a simple design, I guess.
Well, this gets us back to a question you asked at the beginning, Marcus.
Yes.
It's a very good one about what should be in 401k accounts and should private equity, for example, be there. Now, I'll just give, we say just a little bit about this in the book, not very much. I'll give my personal view. I don't know if Tarun will agree with everything I say, but I would say, there's pros and cons of private equity in 401ks. The pro argument is that private equity is an important component of wealth. And we know that finance theory says the benchmark investment should be the market portfolio of all wealth, including private equity. Now, the counter argument is that you don't hold private firms directly. You hold them through private equity funds, which charge high fees, number one. Number two, there's likely to be adverse selection in the private assets that are put in the funds for 401k plans, as opposed to the funds for large institutions or ultra high net worth individual investors. So the 401k investors are likely to get sort of the bottom of the barrel.
Yes.
And then number three, if individuals can choose their own portfolio weights, my concern is they're going to over-allocate to private equity because of the smoothing that hides the risk. This has actually deceived, I would argue, many university endowments. They've invested too much in private equity because they don't perceive the true risk. And if these endowments, who are professional investors, can make that mistake, I'm sure that individuals in their 401k plans will make that mistake. And so, to me, those three counter arguments are stronger than the initial case for, so I would vote against. But I acknowledge that there are arguments on both sides.
Tarun,
do you want to weigh in as well briefly, or?
Yeah, no, I mean, I sort of look. I think on that specific question, I'm in full agreement on the cost. I mean, in a previous life, I did some work on hedge funds, and the same arguments apply there as well. Which is, I sort of saw this succinctly put. I think somewhere there was some viral post that said, one person's democratization is another person's easy liquidity. Okay, so you sort of worry a little bit that this is what's going on, and there's enormous adverse selection that one must be concerned with in this case.
Very good. I think we went big over time today, but it's an interesting and important topic. And as you pointed out, it's not only about giving advice how to best invest, but also how to set up the system for society such that we can actually have a less polarized society and supportive of capitalism and the dynamism in capitalism. And so I'm very grateful that you came to the webinar series, and I wish you all the best luck to push your agenda forwards and improve our societies across the world.
Thank you very
so
much,
Markus.
Thank you. Thank you for having us.
Thanks a lot.